Again, last couple of theory lectures, which might bore some of you because a complete 2 hours theory will definitely is a no-no, at least for me. And that too on the Sunday afternoon, it's really difficult, but please bear with me. Okay, so today's lecture will maybe first 40 odd minutes we will spend on risk management, maybe less than that. And then another 30 odd minutes we will try to spend on the case studies in risk management. So depending upon your interest on those case studies, we might finish off early if there are no questions. If there are a lot many questions, then we might take 2 hours. But most probably for today, I don't think so. Complete 2 hours will be required, but I don't know. Let's see how things pan out. If you have any questions, please free to ask. Okay. So our module speaks about enterprise risk management. Now, we have seen risk management. Enterprise means for a complete organization. A single risk management for complete organization is enterprise risk management. And it's not in silos. Like risk management for finance is different, risk management for operations is different. No. So enterprise risk management is for complete enterprise, and then you have the bifurcation for the same. Okay. So traditionally it is silo based. Silo based means, okay, so risk management of finance will be done by finance team. Risk management of operations will be done by operation teams. And basically it was in isolation. So they were not interdependent. So finance used to look after its own risk and they used to fight with operations for the risk. Now, the higher level management used to create fragmented information and different measurements methods. So finance used to measure in terms of VAR. Operations used to measure in terms of drawdown time. So, or machine downtime or lost time. So every opportunity lost time by marketing. So every, what you say, a different department used to measure risk differently. Now, enterprise risk management is a centralized risk management framework for managing the company risk, organization risk, and now even countries risk. So now even countries are trying to do a country level risk management, especially after Bangladesh SWIFT trade transaction. Have you heard about this SWIFT trade transaction? That was an what you say, IT. Yeah, sorry.
Currency, foreign currency related. SWIFT.
Yeah. SWIFT is foreign currency related trade transaction, but there was an hacking attempt on Bangladesh Central Bank for almost $1 billion. So they got. We will see that they got the credentials of an employee and the SWIFT account of Bangladesh Central Bank was handled by New York Fed Reserve of USA, and the standing instructions were given from Bangladesh to New York for transferring of $1 billion to various firms across Philippines, Sri Lanka, and other countries. So 37 orders were placed, out of which 5 orders were executed of almost $100 million. And then due to one spelling mistake, Fed stopped the transaction. And these 100 million were then routed to different casinos all over the world. And it was converted into cash. And only out of 100 million, 19 million was recovered from Sri Lanka. Remaining 81 million is still untraceable. From that point, even countries are trying to do risk management. Now, this happened recently, I suppose, in 2015. Okay. So, centralized framework to manage the risk. View risk as a component of a whole. What are the risk management tool? Avoiding the risk, retaining the risk, mitigating and transferring the risk. We have seen all four types. Okay, so differentiation between silo-based risk management and ERM. So it's simple. It manages risk within its line of business, isolated risk management, multiple risk matrix, difficult to enterprise or aggregate risk, and this can create a lot of harm to company if company doesn't look for holistic risk. In the next chapter, we will see some examples how this affect. Hedging risk with specific risk transfer tool like derivatives, credit default swaps. Risk management and risk transfer are not integrated with the balance sheet. Okay, now ERM, this is enterprise risk management. So just opposite of this, it reviews risk across all business types as well as concentration to avoid the cost of overaging. Integrated risk management, and you have chief risk officer also. So as chief executive officer, chief financial officer, now they have chief risk officer also. Multiple matrix, I have already told you. Now they use basically a single matrix for complete organization, and its frequency is also decided. Aggregate risk across the business line. Potential cost, yes, a lot of cost saving happens due to a single hedging, wherein there will be no over hedging. So finance will also hedge, operations will also hedge, and so there will be over hedging. Risk management is integrated with bank capital management strategy, balance sheet, and financing strategies. Okay. Motivations why enterprise risk management. First of all, benefits. Then you can define the risk, which risk you are okay to handle, which risk you want to hedge, and all that. Focusing on threats to firm survival, identifying the threats, better management, and regulatory comes. There's nothing to teach you here. Best practices, yes, you must have a corporate governance. Whenever I say corporate governance, is nothing but procedures and policies. Definition of risk appetite, how much risk are we able to take and how much loss we can tolerate. Commitment to risk initiative and require risk management skills. Integration of all key risks. Now, even big companies are including risk like COVID risk, which was not there previously. So, after COVID, many companies are changing their models, especially war models. Now, let me tell you what happens. Company will have its own model as per Basel norms, which is called as internal risk model. And companies or banks can have their own model. Now, the condition is that if war is breached 3 times in a year, that's okay. But if it breached between 3 times to 4 times, 3 times to 5 times, you need to increase your capital. And if war is breaching more than 5 times, greater than 5, then you need to change it model. You need to change your model itself. And then have quite good capital in order to lower your risk. We will see all these things in coming chapters. Clearly defined role, risk, role, and responsibility of CRO and other people working in risk management field. You should do audit. There should be monitoring target and oversight committee for ERP. Okay, so basically, what are the various dimensions? From what angle we should look for ERP? So first of all, target should be set. Just like marketing target, you must have a risk target in place. So we will try to reduce the risk taken by our bank by 5% in this year, or our total VAR should not exceed, let's say, 10 million, whatsoever is your target. There should be clear-cut set target goals. Structure, role and governance structure should be in place by considering enterprise-wide risk, measurement, identification and metrics, measurement of impacts, severity and frequency of risk. ERP strategies, basically what are the strategies in order for your company to manage the risk. Now, mostly people were using credit default swap as risk management technique, but nowadays they are moving away from this after basically 2008. Culture is very important. Importance of risk management culture in employees, corporate risk culture in the complete organization. That is important. Okay. It is very important that every person working in your organization should understand the importance of enterprise risk management, and there should be interactions. So feedback loop should be there. Every weekly, bi-weekly meeting should be there with lower level management or even blue collar people who are working in your organization. Corporate risk culture is very important, and it is heart and soul of ERM. Comprehensive ERM program. So basically, everything all inclusive ERM program for effective risk management is widely or is required or is a need of the hour. Now, even in you see in 2020, a lot of companies are breaking up. They are filing for bankruptcy. The reason is that they are not effectively using their risk management techniques. Okay, risk culture and scenario analysis. Now, what is scenario analysis? So basically what we do is that we take different scenarios. Let's say 1, 2, 3, 4, 5. In scenario 1, let's say our revenue decreases by 10%. In scenario 2, the revenue doesn't increase nor decrease. In scenario 3, the revenue will increase by merely 5%. In scenario 4, revenue will increase by 20%. And scenario 5, revenue will increase by 40%. So if these are 5 different scenarios, what will be the impact on net income or net profit, or what will be the impact on earning per share? So you calculate all these things. So this is pessimistic scenario, this is most likely scenario, and this is optimistic scenario. You can take n number of scenarios. You can do Monte Carlo simulation. So in book 3, we will see about Monte Carlo simulation, and I will show you how to do it on Excel also, so that it will be easier to understand all this thing. So for different scenario, calculating net profit, earning per share, or even VAR in that case, are a part of scenario analysis. Okay. Then explanation of risk culture and its influence on employees' behavior. So nowadays there is a new culture coming up in corporate culture wherein every person who is in financial industry must take complete 1 month vacation and at a stretch. So why is it so? It should it is not there to reduce his stress. So when he is out for 1 month, someone else will work on his behalf. And when someone else is working, he might find something wrong which he must have done. Therefore, as a procedure itself, it is compulsory for people who are working in MNC to take at least, let's say, 3 weeks or 4 weeks at a stretch leave. And it's compulsory. So that's a new culture which is coming in the market. Okay, challenges in establishing a strong risk culture. So basically, there are many challenges while establishing a strong risk culture. Basically, HR team will not be happy for giving 1 month paid holiday to these people. So there are many issues, but big companies are really coming up with a good risk culture.
Now in banking, our RBI norms is there for the leave of 1 month or the 15 days. It's a compulsory.
Is it in India?
Yes, yes, yes. In
Great.
our bank also.
Good. I was not knowing this.
Yeah.
Okay. It's good then. It's really good.
Yeah.
Okay. The characteristics of strong risk culture. What are the characteristics of strong risk culture? So, which risk culture should be said as strong risk culture? Okay. So, when you have clear risk goal and values, wherein I am saying that my VAR should be less than 10 million, openness to dissent and effective communication, alignment of compensation plan with risk appetite. Yes, this is very important. First, you will find that there was alignment with revenue. So, higher the revenue, higher is the compensation. Right? Now, they are trying to align with risk management. So, lower is the risk, higher is the compensation. That's what they are trying to do it. But it's not feasible because it's not logical. Clear accountability and expectations. This is very important. Knowledge of firm risk appetite and risk literacy. So nowadays, many companies, what they are doing is that they are taking a small questionnaire, which is MCQ type, and they're trying to find out whether everyone are risk literate, they understand what is going on, and all that thing. Flow of risk information and integration with decision making. Yes. So it is compulsory now that chief risk officer should be there for any decision making. And without his approval, firm should not go ahead with decision making. Stature and influence of risk management. Yes. Risk managers should be influential and they must have teeth. Otherwise, it's not a strong risk culture. Yes, many a times, if someone is telling something or something is going wrong in your company, before the people used to harass him, people used to hate him. Now, whistleblowing is encouraged, at least in strong risk culture, wherein if you are trying to tell the company that, okay, these wrong things are happening in the company, it is encouraged, and his name, if he wants, will be kept confidential, and decisions will be taken. Board understanding of enterprise risks. So even boards should be what you can say, educated about the various risk which a company is facing and how to reduce the risk. Action against offender and identification of risk incidents. So how many incidents that took place in last 1 year in our company and how we can mitigate it. Okay. Multi-layer nature of risk culture and individual influences. These are the challenges. So what happens is that the organ, like let's say there is an employee. Now he doesn't have a single boss. So there will be three bosses who will ask him to prepare three different reports. And then there is a fourth person who has a lot of influence on this person, and he might ask him to do something. So basically, this should not happen. There should be clear-cut structure, hierarchical structure, and depending upon that structure, the person needs to escalate the process. Factor influence like risk, attitude, demographic, background, and experiences. There is nothing to worry about. Yes, influence of peer and management on risk behavior. It so happens that if you try to implement risk matrix in the organization, especially the people from marketing, they started hate, they started, or they will start hating you, and then the organizational politics will set up. They will make sure that okay, your promotion will not take place, and therefore the chances that these people will also keep risk management aside. So basically, managers or marketing managers in even in banks, they will try to increase their sale no matter what. And now in India, you will find that okay, if someone wants to take loan, uh, a person will go take his signature on the form and then afterwards fill the form depending upon the liking or depending upon the policies. This is a very wrong culture, and a lot of foreign banks are opposing this, but the marketing manager, they really do not want to go to the client for 3 4 times and make client aware about various issues which they are facing. I remember I wanted loan for 3 years in order to purchase the car. And I suppose, as per the rules of the bank, uh, 3 years loan was not feasible for me. So without asking me, they changed it to 5 years. They gave me the loan, and after 1 month, I got the papers from the bank. And after 2 years, I came to know that oh, it's not 3 years, but it's 5 years. But it was too late. But as per Indian mentality, but that is not okay as per the international culture. Measurement methods create risk. So there are indicators to measure the risk. So we call it as key risk indicators, KRIs, which are very important. We are going to see in third book regarding key risk indicators. External factor, industry, professional norms affect the risk culture. These are all the limitations. Basically, challenges means limitations. Okay. I already told you what scenario analysis is. So basically, in scenario analysis, you have pessimistic scenario, most likely scenario, and optimist scenario. So you try to find out your books of account for pessimist, most likely, and optimist scenario also. Wherein in sensitivity analysis, you just change one value and try to find its impact on your bottom line, that is net profit. So in scenario analysis, basically scenario analysis is used to understand the effect of abnormal or tail events. Now, the definition of tail event is very, very difficult. In the next chapter, we are going to see about one person who used to sell put options. And this was in 1987, I suppose, 85, 87. And daily, he used to sell out of money put. So he used to take bets below 5%. So even if the market crashed by 5%, still he will be in profits. So out of the money put option he used to sell. And what happened one day, uh, in 1987, the market crashed 7% in a day. So basically, he was just in loss of 2%, but mark to market was almost in $160 million. He could not pay $160 million that day. Therefore, his total position was cut off, and then he made a huge loss. We will see all that. But basically, he was ready to look for a pessimistic approach of 5%, which was not possible during those days in 1987. The volatility was too low. So the market falling 5% a day was one odd event in almost 1,000 days. But that did happen and he lost. Importance of scenario analysis and risk identification, trying to find different scenario and its impact, and are we ready to take that much risk? That is very important in understanding of scenario. Okay, what are the advantages? Okay, possibility of risk rather than frequency. Yeah, so we try to find out that, okay, how much loss we are going to suffer, not in percentage terms, but in actual rupees terms. And transparent narrative. So basically, it clear cut tells us that, okay, if the pessimist scenario comes, then we will make a loss of, let's say, $300 million. And so even a person who is not a technical expert can understand these terms. Focus on key risk types, and there are its exposure, basically key risk indicators that we are talking about. Majorly liquidity risk. So if you see the next case studies which we are going to look for, company or banks will never fail because they are not in profit. If you know, Ola is in loss from last 10 years. But still, it's running. So it's not about profitability, but it's about liquidity. What is liquidity? Having cash on that particular day to give back the money. Okay. Identification of warning signals and contingency planning. So if your mark to market is increasing, that is a warning signal. If people are using more than 50% of their credit card limit, that is a warning sign. And then you must have contingency plan that, okay, if he started using more than 75% of his limit, start looking for him and reduce his, what you say, limit. Forward looking based on historical data. So basically you predict the future for pessimist, most likely, and optimist. Use of risk appetite. So how much risk can I take? Risk limit. This is the money which I have taken out, and I will stop this product if this limit is breached. And capital planning. How I am going to get the capital which is required for risk appetite and risk limits. Disadvantages of scenario analysis, difficulty in estimating probabilities of adverse effect. Yes. So basically, I told you pessimist, most likely, and optimist. If you see, in last 50 years, rather last 90 years, market had not seen anything like COVID. So what was the probability of COVID happening? So it was too low. So it was very difficult to estimate the probability of an adverse effect happening. Now, the complex nature of scenarios, basically when we use Monte Carlo simulation and random number generator, it so happens that people with no technical background does not understand how this scenario popped up. Potential underestimation of events and their effects. If you remember JP Morgan's London whale case. So the CEO, just before the loss of $6 billion, the CEO said, "Oh, this is a very small thing, and you need not have to worry about regarding a small loss of 500 million is nothing." And then next day it doubled, and then next day it doubled, and the next day it tripled, and that's where it stopped. Selection of right scenarios and warnings. Yes, right scenarios selection is very important, but forward looking, it is very difficult to use that. Why? Because we generally use historical data in order to calculate or find out the scenarios. Reliance on past crisis instead of future risk. So basically, we look at the past because history repeats itself, and therefore you should rely on past crisis instead of future risk. So basically, you should not rely, but you generally rely because you do not have any measure to calculate the future risk. So what you do, you try to find out past crisis, and depending upon that, you try to prepare a scenario. Okay. Challenges in accessing the credit. No, we calculate the scenario, but how do we test the scenario? There is nothing to test the scenario, right? So because we cannot see in the future. And the lack of quantification. So basically, the scenario analysis is based on assumptions, and every person can have his or own assumptions. So these are the disadvantages of scenario analysis. Okay. Stress testing and capital planning. So what is stress testing? I try to find out that at what point my company breaks. So that is called stress testing. I keep on increasing my loss and see at what point what breaks. That is stress testing. And capital planning. How much capital I should keep aside for risk management. So I need to explain the explanation of scenario analysis in stress testing program. Use of scenario analysis to assess the risk and performance. Historical and hypothetical scenario in pre and post crisis period. So you want to see how your company does in crisis. Try to do a simulation for pre-crisis, post-crisis. So importance of considering how risk interact and market behavior changes. So scenario analysis helps us to understand how the market behavior changes. Now, okay, that I'm going to tell you in the next chapter itself. Basically, in 1970s, how bank used to work is that bank used to take CASA deposits and give long-term loan. Current and saving, and so they used to pay some 2%, and they used to give loan at 8%, and then 6% was the spread, and they were happy with it. But suddenly in 1980s, you see the yield curve changed. So short-term rates were high and long-term rates were low. But unfortunately, they had already given long-term rates at 8% and the short-term rate became 9%. So banks started losing money. We will see. So that's very important to consider how risk interact and how market behavior changes. So market behavior changes very quickly, and especially in banking sector. Okay, now these are the US stress testing program. These are the programs basically created by US government for stress testing whether the model or whether the product or whether a bank can survive any drawdown of 5%, 10%, and so on and so forth. So macroeconomic scenarios like baseline, adverse, and severely adverse. So I took pessimist, optimistic, and most likely, right? Similarly, they have baseline. So basically, baseline means 5%, adverse is minus 10%, and severely adverse means, let's say, minus 25%. How will you survive during those scenario? How you should act? That all comes in scenario analysis. Requirement of forecasting of balance sheets, income statement, and capital plan, along with cash flow statements also. So for all baseline scenario, adverse scenario, and severely adverse scenario, you need to calculate the balance sheet, income statement, and capital plan. So basically, you need to forecast. Okay. It has been already told to you that during capital planning, you need to consider enterprise risk management. Now, if you remember about Suzlon, Suzlon is a wind energy company. It was well known during 2010. I'm not sure whether you know it now. Somewhere around 2012, it almost filed for bankruptcy because it took loan at some 3% from Europe, where in India, people used to get loan at 9 to 10%, especially corporate loans. But what happened after five years when they were supposed to pay back the loan, Indian currency depreciated by almost 15% as compared to euro. And so rather than paying 3%, he was supposed to pay much higher amount. And therefore, Suzlon was almost bankrupt. Now it is coming back. But then for 10, 15 years, the Suzlon was almost bankrupt. Okay, example of contingent convertible bonds. These are very important. I'm not sure whether you know what is convertible bonds and again contingent, but I will try to spend some time on. So the bond which can be converted into equity shares, these are called convertible bonds. And contingent means depending upon certain things happening. So let's say if GDP of the country falls below 3%, the bonds will get converted into equity shares. So you will no longer get your coupon, but you will get an equity share for the bond. What will happen because of this? The immediate liquidity requirement of the bank or a company will reduce. Or let's say but these are based on macroeconomic event, okay? And not on company specific risk. So you cannot have contingent convertible bond saying that, okay, if profitability is less than 5%, let's convert your bonds into equity share. No. So it should be based on a macroeconomic event. So if a macroeconomic event happened, then I can convert my loan into equity share, and that is called contingent convertible bonds. And this is a very good risk transfer tool wherein My capital increases, my loan decreases, my liquidity requirement decreases. Okay.
Sir,
Hmm?
please repeat this part, the contingent convertible bond.
Yeah. Okay. So do you know what is bond? First, let's start from there.
Bond like government bond that
Yes. Okay, perfect. So it's good. Okay. So basically what happens, every company, banks, they give bonds. What is bond? Bond is nothing but loan. So company takes loan by issuing bonds. And on that bond, you have coupon. There are some zero coupon bond also. And maturity date that after 5 years, I will pay you back 100 rupees. Now you give me 100 rupees. After 5 years, I will give you back 100 rupees. Plus every year, I will give you 8% coupon. That is called interest. Now these are the bonds. Now it is mandatory for any company to repay the bond, right? So it's 100 rupees bond. After 5 years, they will have to pay back 100. So after 5 years, the liquidity is required to pay back these bonds. But when they are convertible bonds, these bonds can be converted into equity shares at a prefix ratio. Let's suppose 1:1. So bond can be converted into equity shares. Those are called convertible bonds. Okay. So let's say there is a clause that after 5 years, the investor who, the common retail investor or institutional investor who has invested in their bond, will have an option to convert these bond into equity share. Now let's suppose the price of equity share is 120 and the price of bond is 100. It is always viable, feasible for a people or for an investor to convert it into equity share and get 120 rather than getting 100 rupees. But if the market price is 80, what investor will do? They will keep bond as it is. But if the market price of share becomes 150 also, they will try to convert it into equity share and get 150. This is a win-win situation. Why win-win situation? Because the company who has issued the bond will not have to pay money back because it get converted into equity share. It is also beneficial for the investor because rather than getting 100 rupees, now he is getting 150 rupees. So that is called convertible bond. The bond which can get converted into equity share at a pre-decided ratio. That is called convertible bond. Let's come to contingent convertible bond. So the contingent convertible bond are those bonds which can get converted into equity not as an option but based on certain future event. Now the event can be, let's say, if the GDP of the country goes below 3%, then this bond will get converted into equity share and our company will not pay you 100 rupees back. But whatever will be the price of the equity share on that day, you will get one share. So that is based on contingency. What is contingency? Future uncertain event. Let's say if there's a recession, if there is a depression, what is the definition of depression? 3 consecutive reduction in GDP is called depression. One reduction in GDP is called recession. So depending upon the contingency or depending upon the future uncertain event, When you convert your bond into equity share is called contingent convertible bond. You understood?
So it means it defined by the company.
Yeah, yeah, it
When
is defined by the company itself. Yeah.
okay, so company decide when uh, if the situation is in a good shape, it can be in liquidity mode or maybe it
No,
transferred
no,
to the
no,
equity
no,
share, that is convertible bond.
no.
But
So while giving bond itself, 5 years before itself, while taking out bond for the first time, they decide based on the contingency,
okay,
not
so
after happening of the event. Yeah.
okay, so it is predefined.
Yes, yes, it is predefined. It is
Okay,
always predefined.
okay,
Yeah. So this 3% of the GDP, this is predefined. Company will not define on the time. No, it will always be predefined. Okay. So contingent convertible bonds is done. The role of CSAR. So basically, we have seen the models, right? Stress testing model. So this CSAR, SCAP, and DFAST. These are the stress testing program used in US. So basically, this is capital analysis in understanding the risk and interlinking the factors. So basically, this is a model which is used for ERP or scenario analysis. Then benefit of stress testing unfolding over time. Reverse test stress testing. This is important. So basically, I want to find out that okay, for a loss of 100 million, what should be the loss of revenue, or what should be the volatility which should be there in my model. So first of all, I decide the loss, and from that I backtest and try to find out what's the volatility. That is called reverse stress testing. So if this volatility comes, what will be the loss? That is called stress testing. But I first decide the loss and then try to find out the volatility. That is called reverse stress testing. Okay, strategic decision making and use of
so
scenario analysis. Yeah.
uh, that is whenever in the balance sheet at the
Okay.
time of uh, loan default provisioning. So if we have provisioning, that is 1% loan will be default.
Okay.
And if the money like 100 crore
Okay.
for uh, yeah, one financial year. So this is the reverse trace testing part.
No, 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 no. Let me tell you, reverse stress testing part is what. Okay. So basically, what happens is that you do testing, VAR testing or stress testing, and you find out that okay, my loss can go up to 100 million. And then this $100 million you keep aside as reserves. Okay, good. Now what you do, you just take any arbitrary value, let's say 1 billion. What will be the parameters for the loss to go up to 1 million? 1 billion. So at what volatility will my loss go to 1 billion? At what operating risks will my loss go to 1 billion? At what revenue, or at what negative revenue will my loss go to 1 billion? So checking all these parameters from an arbitrary loss value is called reverse stress testing. You understood what I'm trying to tell you?
Okay. So first we decide amount.
Yes. First
Then
we
we go for the testing part.
Yes, then we go for reverse testing. So in stress testing, what we do, that we first decide our volatility. That okay, in last, let's say 10 years, maximum volatility was 15%. So take 15%. In last 10 years, my VAR was, let's say, 37%. So take VAR value as 37%. And from all these things, calculate the loss. That came out to be 100 million. This is called stress testing. That okay, let's make this minus 15, let's make minus 20, minus 25, and see how much is the loss. Let's increase the volatility to 50% and check what is the loss. This is called stress testing. So checking for loss is stress testing. What is reverse stress testing? You already assume the loss. And then check for the parameters that if the loss is 1 billion, how much will be my volatility? That is called reverse stress testing.